Is your practice tired of wrestling with insurance denials, deciphering EOBs, and watching your revenue slip through the cracks? You are not alone. Welcome to The Claim Game, the podcast designed to cut through the confusion and provide you with the best practices for revenue cycle management success. We are Jeremy and Catherine Zug, and we've been with people just like you in the trenches. Each week, we'll break down complex billing processes, share real-world solutions from practices like yours, and ask questions of the game makers and changers of healthcare so you can take control of your revenue. Let's turn those claim denials into deposits and help you return to focusing on patient care. It's time to win the claim game.
Welcome back to the Claim Game Strategist. As a reminder, every so often, we like to take a strategic pause and get a behind-the-scenes look at the very board we're playing on by talking with the game designers. Think of this as consulting the game makers and the game changers themselves, the architects and the muses of the game. Special rounds offer invaluable insights into the design and development of the healthcare language. And by interviewing these individuals of our complex system, the insurance companies, regulators, and other key players, we gain a better, deeper understanding of the rules and nuances of the board of healthcare. So this knowledge is meant to give you a strategic advantage, an edge that you wouldn't otherwise have, allowing you to navigate the terrain with more clarity and to make more informed decisions. So get ready to learn directly from the game makers and enhance your understanding of the claim game. And today our game changer is Dan King. Dan is the co-founder and in-house counsel at Fireside Strategic. He is a former lawyer turned private equity strategist and burnout crusader. Dan began his career in mergers and acquisitions law at one of the largest firms in the world, and then working on the deal team of one of the sharks on the Shark Tank TV show, doing contract drafting and due diligence. He saw many small companies grow so quickly that their people eventually burned out, and he became passionate about the human side of business and left law to train as an executive coach. He's built several companies in the coaching industry, eventually selling one, which served the legal industry. At Fireside Strategic, his company, he leverages his experience with mergers and acquisitions and organizational psychology to build a mental health business without burnout. Dan studied law at McGill University and psychology at Columbia University. He's a world traveler and veteran of 2 extreme auto races, driving a Fiat from London to Mongolia and a rickshaw the length of India. Please welcome Dan King. All right, Dan, welcome to the Claim Game podcast. You've had quite a journey from mergers and acquisitions law to private equity and then executive coaching. And now you're building a really unique business. And we really appreciate you being on the podcast. So welcome.
Thanks for having me, Jeremy. I always so enjoy our conversations, and I'm not just making that up. I really do.
Oh, great. No, I do too. I feel like we could talk for a long time about private practice and evolving landscape in healthcare. But what was the aha moment that shifted your focus from really high stakes deals in a public forum to a more human side of business?
So, I started my career at one of the biggest law firms in the world, and then doing some of the legal aspects of mergers and acquisitions. I was playing a very small role in very big transactions. And then I flipped to working on the Shark Tank show for one of the investors there, playing a very big role in very small transactions. This was the early days of Shark Tank. And a lot of the companies were very, very small. So this was 2012, 2013. And we would invest in those companies. If they weren't on TV, they probably would have been a little too small for us to invest, but they were on TV. And we knew that the TV show in broadcasting these companies to the whole country, right, was going to grow them. And it did. Any company, even then, but especially today, that goes on Shark Tank explodes for 6 months. And you learn a lot about culture when that happens. When a company grows so quickly, They need to make a lot of people decisions, often without intentionality. So you need to hire a ton of people if you're growing very quickly. So these Shark Tank companies needed to hire people. And these were first time founders generally who had no understanding of organizational culture, the people side of business. And nor did we, to be frank. We didn't know much about those things. I didn't know a thing, but I found myself very interested in those questions. And I always knew at some level I wouldn't just be an ordinary lawyer. I wouldn't spend my life being a legal advisor on transactions. I knew I wanted to do something else. I wasn't quite sure what. When these people issues emerged, I found them really interesting. I was more interested in them than the legal work I was doing. So that was kind of a sign that I wanted to study that stuff. And I should have paid a bit more attention to the fact that my mom built a career in that space. So the apple doesn't fall too far from the tree. So long story short, went back to school and studied organizational psychology, trained as an executive coach, and knew that I wanted to integrate that into my career.
Oh, that's amazing. That's a great story. So when you say your mom built, I know you said it's a short story, but I'd love to hear a little bit about that story. What was your mom's history with that?
So my mom is very modest and humble, so I will brag a bit for her.
Oh, good.
She grew up in the UK, immigrated to Canada, where I grew up, and she lived in the province of Quebec, which is a French-speaking part of Canada, and learned French very quickly and became, in part because she was this unusual English woman living in Canada, in French Canada, but became bilingual. She was the first female bank executive in Canadian history.
Whoa.
And she did, she was a VP of HR at a very large bank. And that enabled her to develop a whole host of different skills in the people side of business, from the nitty gritty stuff of payroll to coaching to culture, the whole gamut of the people side of business. So I grew up watching her. She ultimately met my dad and moved to a much smaller town where I grew up, and she had to give up her corporate career, but started a combination of a coaching and a downsizing practice. And so when I was growing up, I would watch her do that work. And that's, for her, she really loved the process of helping executives become better leaders. She also really enjoyed, I would say enjoyed, but she did a lot of work helping fire people kindly.
Oh.
And so downsizing, if you've ever seen the movie Up in the Air with
Yeah.
George Clooney,
Yeah.
you could call some of her work was doing that in as kind a way as you could hope to do.
I feel like we could have a totally other episode on how to fire people kindly. Seems like you probably have a lot of wisdom and background, but sounds like the apple doesn't fall too far from the tree, huh?
It doesn't. It doesn't. Definitely that. But I think it's interesting growing up as I became closer to my mother, and in early adulthood, as I got closer to my mother, I started to open my eyes to the skills that she had, which I didn't really have an interest in when I was much younger. And over time, I started to see, wait a second, there's this whole part of me to discover. And so, I think that there are certain businesses that draw on the entirety of the person that started them. Some businesses feel a little more, I want to say, concrete. Some businesses are building widgets, selling widgets, and that's perfectly fine. We need a lot of that. Other businesses are a little different. Other businesses are a distillation of the essence of the founder or founders, right? And so a business that gets me excited is much more in that latter category. And so you're absolutely right. The part of me that is so influenced by my mom, I needed to integrate that, understand it, develop it in order to do what I do now well.
Yeah, and going back to the days where you saw sharp growth, trying to figure out culture, talk a little bit about what you have seen in terms of maybe the biggest misconception about rapid business growth that you've observed.
Maybe the biggest one is that you can get the growth done first, and then the people systems and the operational systems, we'll build those later. We'll just kind of watch what's unfolding and then build the systems later, because
Oh,
priority
interesting.
number one is growth, growth, growth. And look, I'm a capitalist. I'm a believer that businesses should be profitable. And I think that there's a very long-term, more sensible way to run businesses that is harder to implement in an age of rapid technological change, of everyone feeling like our phones are deepening our ADHD, right? And so I don't think most people are going to defend the idea that we shouldn't build it. We should just grow the thing and then figure everything out in terms of systems later. Even though people won't defend that, it's what they do in a vast majority of cases.
Oh,
And
for
so
sure.
there's an amount of intentionality that I think can get a business to a place where you understand what you need to have in place before you grow. And even in doing it, may mean that we grow a little more slowly at first. And I am totally cool with that, because the aim is not to grow as rapidly as possible tomorrow. The aim is to build something that works well culturally and financially in the longer term. And those two can be mutually reinforcing if you allow them to talk to one another. A lot of people pay lip service to culture, but don't actually really in the end. And it is just as important as the financial piece.
Oh, for sure. Yeah, especially in the work that you're doing now. So Fireside Strategic, talk about your mission, what you're hoping to accomplish, and how what you've just got done explaining for all of us, how that blends nicely into the work that you're doing.
So Fireside is a social impact acquisition firm exclusively in outpatient behavioral health. And our mission is to acquire sort of 3 platform companies in 3 different states with a focus on the US East Coast, to grow them substantially while treating the people like gold. So the aim for us is to create this sort of system where people and profit are mutually reinforcing, and where patients get great outcomes in part because the clinicians are treated well, which in turn generates more profit. And so what that looks like in practice is often taking a business that is exclusively therapy, some of the larger therapy practices on the East Coast, and adding other services. It could be ethical medication management, it could be Spravato, it could be psychological testing, TMS, adding those services, which in turn, they tend to be higher margin than therapy. When you give a business margin, now you can pay people more if you choose to. You can build infrastructure. You can build systems that you couldn't before. And when you get those higher margins and those higher margin lines of business in place, patients are going to get better outcomes. They're going to send more referrals to your business. You also have more leverage to negotiate with insurers. I know that's something near and dear to your heart, Jeremy. And so people really benefit from those higher margins. And in turn, the higher margins benefit from people that are treated well too, right? So the whole thing is a virtuous circle. And it's a model that may mean a little less growth up front, but you take your time to get things right. And then you build a different type of behavioral health business, which our country right now is in desperate need of.
Yeah, that's right. And I think you've said a lot of compelling things there. So just to summarize what you've said, you are in the business of acquiring 3 platform companies and then adding on to those companies to build a social impact infrastructure. Did I get that mostly right?
Yep. Wouldn't disagree with any of that.
Yeah. One of the things that when we met at a conference recently, one of the arguments you made that I found particularly compelling goes something like practices that take insurance companies on an in-network basis are more valuable from an enterprise perspective. Can you expound on that at all?
I think
Okay.
most acquirers in behavioral health, I can't speak for healthcare generally, though I
Mhm.
suspect the same is the case for healthcare generally, but in behavioral health, yes, absolutely.
Can you explain that a little bit? Because I think for me, it made me kind of scrunch my eyebrows a little bit because I would think that they would be worth less from an enterprise perspective, just because the allowed amounts would be lower than you can command for a cash pay. So there are I hit some logical barriers, but can you help me understand that a little bit more?
Yes. So it's unbelievable how different the ins and outs of a cash pay business are from an insurance-based practice. And even more so, we can talk about commercial insurance or we can talk about government insurance. I
Oh,
see them
interesting.
as
Yeah.
3 separate universes, right? We actually do have an interest in self-pay practices. We prefer commercial insurance practices. Don't look at government insurance practices. And if it's interesting, I can get into why.
Yes, please.
But there is a level of scalability that is possible in the insurance world. There is a greater variety of patients that you can support. So even if you look at the wealthiest places in the country, you look at New York or you look at San Francisco, those are places that can support very well compensated self pay therapy. Even there, you're limited in terms of the number of people you can reach, first of all. If you look at a commercial insurance plan, you look at who can be covered by that and the fact that, hey, I don't have to pay for the entirety of the healthcare that I receive. You make healthcare available to a wider variety of people. That's point number one. But there's also something really cool from a business perspective. We are on a journey of fighting for higher reimbursement rates, right? So in the states where we're operating, it's important for us that our clinicians get reimbursed at as high a rate as possible. We advocate for that in a whole host of ways. In a majority of states, if we successfully advocate for one of our practices for a higher reimbursement rate, with most insurers, we buy another practice that has a lower reimbursement rate. We can apply the higher rate to the lower practice rate. We can apply it to all of the practices in the state, usually within 90 days, roughly. So not only is it the case that more people can be served by commercial insurance, but it's also the case that there's a level of scalability which is pretty hard to find in general and behavioral health that you can get through some insurance arbitrage. You follow me?
Explain what arbitrage is. It's a fancy word.
Sure. So there's an opportunity through the contracts, okay? Not every contract is written exactly the same way. So I'm not saying that there aren't exceptions, but generally speaking, okay, most of these contracts, you have the ability, if you own multiple practices in the same state, the practice with the highest rate can get applied to all of the practices in that state.
Oh, interesting.
And
okay.
when that happens within 90 days, there is a level of revenue growth and in turn margin improvement that you can get as a business owner, which is quite dramatic. And so as an acquirer, I don't have that same level of scalability with self-pay practices. That just doesn't exist, right? I would have to, with a self-pay practice, I would have to increase the prices on the customers rather than the insurance company. That's a very different journey.
That's not going to happen in maybe rural America or other cities that can command a higher rate.
I mean, each patient has to make that individual, even if I'm doing it in the wealthiest part of New York City, each individual patient has to accept the higher rate.
Right.
Whereas it happens much faster in network.
Oh, fascinating. So could a practice owner, and like you said, you don't know if this is the case for all healthcare verticals, but theoretically, could a practice do what you're doing? Like if they absorbed a practice, could they do what you're describing?
It's absolutely possible. And, the journey of doing acquisitions well is not easy, right? So there's a lot of expertise required in doing it. I'm gonna say it's not for the faint of heart, right? No. So there's a ton of legal, financial, there's so much involved in doing acquisitions well. It's really not for the faint of heart. But yeah, anyone theoretically, if they did acquisitions, could leverage the same benefits that we do.
God, I'd love to hear your thoughts on when you look at specific types of insurance companies, right, or certain characteristics of an insurance relationship.
Yeah.
Are there any types of insurance that make them a better, game partner, for example, or like a better insurance partner for a practice looking to optimize for a future, M&A partnership?
So I'll give you a couple of things off the top of my head. It's a really good question. I don't think anyone's ever asked me that question quite that way. So you want to evaluate their responsiveness. So if you were to do a deal with us, even before we come in and think a little bit differently about how to negotiate with an insurer, do they treat you with a modicum of respect? Number one, right? Do they arbitrarily decrease your rates with no notice? Is it really hard to get someone on the phone? Are you on hold? If you actually have a relationship with an executive there, do they take you seriously? Do you feel like you're a valued member of a network, or do you feel like a complete number, right? I'd say that's pretty important. Number two is, how much coverage do they have in your state? Are they all over the place? Are they small? There's different strategies we could get into which might play out differently depending on, there might be some situations where you want them to be small. There might be some situations where you want them to be big. But think about whether they have coverage throughout an entire state. And also think about whether you as a practice are exclusively in urban areas or whether you're in rural areas as well. And this matters because I'll give you an example. If they have coverage across the state, probable that there are fewer clinicians in the rural part of the state. You open an office there, the rent will probably be cheaper, but it's going to be the same reimbursement rate for a 90837, whether the clinician is providing the service in a rural area or in an urban area. So because there's fewer clinicians in a rural area, it might actually give you more leverage to argue for a higher reimbursement rate. And if they don't have in the network clinicians in a rural area, it might start out the same reimbursement rate, but you might actually be able to advocate for a higher one because they don't have clinicians.
That makes sense. So it's like supply and demand.
These are some of the really nitty-gritty things to get into.
Yeah, that's interesting. And it's interesting to hear how you think through an insurance partner, right? Because we talk to practices all the time about, is this insurance company being a good partner? And we usually get sort of a glazed over look. Right.
Yeah.
It's like, what do you mean? They're all bad partners. It's like, they're not all bad partners, actually. Some of them are actually very good. I think you mentioned that you don't like government payers.
Yeah.
Why is that? What makes the government payers unattractive? Is that the right word?
So on average, the reimbursement rates are lower. On average, if you think about like why did I say government insurance is a different business? It is more of a volume business. So because the reimbursement rates are lower, you need to see more patients. So it's true that under government insurance, a lot of people are covered that aren't going to be covered under commercial insurance, let alone self-pay. But it's very much a volume business. And look, that people that are covered by government programs matter, and sometimes they're not treated the best. And that's a different problem than I've thought through how to solve. So
interesting. Okay.
We have a model which is about treating clinicians well. And part of that is not burning them out. If clinicians burn out, they're not going to treat patients as well. And that virtuous circle I talked about isn't going to work so well. And so in the commercial insurance world, that model is much easier to implement for a sort of focused acquisition firm like us. In the government insurance world, it would need to be a different model. You see what I mean?
Oh, yeah, I would have to be. Yeah. And you'd have to think through what that looks like. It seems like you'd be playing by a totally different set of rules in that world than, because you have more than one stakeholder now, right? A private insurance company.
And I don't know there's a whole different journey of negotiating higher reimbursement rates there, right?
Right.
Some of the strategies that I've been talking about, and there's lots of other stuff that we do. I don't know how that applies in the Medicare, Medicaid world. It's just not my expertise. I haven't thought it through. But what I've talked about, unfortunately, is just going to be harder to implement in that world. And that's a shame because so many people have government insurance, but it's a different universe.
It's a totally different universe, right? We've seen that with, you look at United Healthcare, and, they've even said that the Medicare Advantage folks are a little bit more clinical than they expect, right? And so you have to deal with a new set of demographic information. I'm sure it's a multivariate world to navigate, and one that I'm not sure where the pressure points are, right? With a commercial insurance company, it's a lot easier to ascertain where the gaps are, I imagine.
100%. And, big insurance companies are big. They're bureaucracies. There's a war of attrition to fight sometimes to argue for a higher rate. And the federal government, that's a whole other enchilada, right?
Yeah, it's just true for sure. And you've seen burnout, and you've talked a lot about building sustainable growth, which I think is the right way to think about private practice, right? Especially if you're in the independent private practice world, because I think you're gonna run into operational issues. How do you choose, right? How does your choice of game partners, whether that be a mergers and acquisitions partner or an insurance company, how does that directly impact the potential for burnout in a practice? Are there red flags you're looking for when you interview people in a practice? What are you looking for there?
What am I looking for? Like, what are red flags in a particular insurer?
Yeah. So if in a practice, right? If they're working with an insurer, have you seen those insurers start to burn out the staff? And then you go, uh-oh, that's a
indirectly in the following way. If the reimbursement rate is like hilariously low, then that's going to deepen the likelihood of burnout. right?
Hmm.
Because in every way, like the founder of the practice and the clinician are splitting however much each reimbursement is. So if that's lower, in an absolute sense, there's less to go around for both the founder and the clinician, right?
Hmm.
And so it's going to mean that the clinician is going to need to see more patients, whether they want to or not, whether they have the capacity to serve more patients or not, right? So when I see private insurers reimbursing at like $45 an hour, which I see in some states,
It happens. Yeah, it does
it can
happen.
happen. I think to myself, this is a recipe for burnout. It's going to be very hard. I think another factor here is the local market, how clinicians tend to be paid in the market and at the practice. And there are certain things that we absolutely look for, which make a deal more interesting to us, which also diminish the chance of burnout. So I would say, if the reimbursement rate is very, very low, and that's the average reimbursement rate is low, not just the rate from like one payer that they don't have that much of a relationship with, right? If a very high percentage of the commercial insurance revenue is, a super low reimbursement rate, definitely makes it much harder for our model to work.
Oh, I can imagine. Yeah.
This episode was brought to you by Practice Solutions. At Practice Solutions, we identify and apply the right billing solution for your unique practice, moving beyond a one-size-fits-all approach. This might look like our full-service, done-for-you billing, where you can take a hands-off stance, a practice health check to identify where you can optimize your RCM processes, or using our practical tools within the Hourglass Learning Hub. One of our billing solutions will help simplify the complexities of working with insurance payers so you can have peace of mind, consistent cash flow, and more time to focus on your clinical mission. Founded in 2017, Practice Solutions was built to alleviate the administrative burden for private practice owners by installing smarter billing systems. We believe your time is better spent with patients, not billing issues. If you're ready to stop stressing about billing and start loving your practice again, visit practicesoul.com today. That's practicesol.com. Mention the promo code The Claim Game to get 15% off your first 3 invoices for done for you billing, 15% off your practice health check, or 15% off your first year in the Hourglass Learning Hub. Again, that's promo code The Claim Game.
Can you negotiate? Can you go from 45 to 85 with an insurer like that? Or do you find that that's pretty much impossible?
I was just on with a practice owner who shall remain nameless, who told me they went from 66 to 100, which is a
Oh,
pretty good achievement, I gotta say. I will not mention the insurer, but that's a real achievement. So there are lots of ways to skin the cat. And I will say that building a real kitchen cabinet of people who have different expertise in different elements of the negotiation process. My whole life, I've loved fighting bureaucracies. I don't know what it is. I just love doing it. And some of my colleagues do as well. And it takes a certain amount of patience. It can become a certain amount of sick fun, right? When you get good at it,
hmm.
but you need to have a lot of patience. And so I don't want to say it's impossible. It might be possible, Jeremy. I haven't seen exactly that jump. More is possible than you might think. And if you have the right people doing the negotiating and fighting the war of attrition, more is possible than most clinicians think.
I think that's true. And I think size in some respect matters when it comes to negotiation, right? One of our other interviews was with Kathy Gilbert, who managed provider networks for a long time. And she had mentioned that 80% of the work in any vertical of healthcare is done by 20% of the tax IDs in her network, right? And so it seems like the larger a practice gets, the more attention is given because they can manage their quality requirements set by the government. Have you seen that to be the case, that the larger practice gets, the more weight is thrown around?
I think to negotiate well, you have to empathetically place yourself in the shoes of the insurer. What
Hmm.
makes a better network for them? Right? It's a network. And so I want to make that network attractive to more and more customers. What's going to make that network more attractive? Well, different kinds of services, as well as, my God, like we have such a mental health crisis in this country. I have so many patients, they just need to be seen, right? So I need volume and I need variety.
Yeah.
Absolutely, both of those can be very, very powerful.
Yeah, we have we're working with somebody who does maternal mental health counseling. It's like the niche. And it's been really fun to watch the rate negotiation with the payer that they're working with because it's a big need and they don't have very much of that in their network. And it's been really exciting to see a lot of yeses come from the other side of the table in terms of a rate negotiation.
Are you, are you working on that negotiation?
I'm included on the correspondence. It's been really exciting to watch. Yeah, it just goes to show you exactly what you just said. You need a lot of variety and diversity in the network. And so if a practice is doing something that scratches that need or meets that need at scale, it becomes really attractive. Sure. Yeah. And in the mergers and acquisitions world, right? If you have a practice owner who is looking to exit, for example, what are you really looking for when you evaluate a practice?
The first thing is alignment with the founder, right? Because we are social impact, we are people focused. We usually operate on a partnership model. So if it's a platform transaction, and what I mean by that is it one of the three main acquisitions that we're looking to do, as opposed to a smaller transaction, which would only happen in a state after we do a platform transaction, okay? So when I say a platform, I mean a bigger business, the first business in a state. There, for us, that's typically a partnership transaction. So most of the time, if you think about buying a business, you think in your head, well, that person's buying 100% of the business. For us, when I say a partnership transaction, I mean something different. I mean that we buy a majority of the business and we leave the founder in place. We don't replace the founder. In behavioral health, that's very important because some of the acquisitions that haven't worked so well have involved replacing the founder with some Harvard MBA type, right? We can get into why that doesn't tend to work so well here. I generally believe it doesn't. So we have a partnership model where we keep the founder in place. And so with the founder kept in place, they continue to operate, but with our support. We can do certain things that may be a challenge for most founders in this space. So we can add some of those new service lines that I mentioned earlier. We can negotiate with insurance companies, and we can do acquisitions. Generally speaking, founders could do some of those on their own. They're not going to have the level of expertise that we bring to the table. So that's a big reason for founders to engage with us. But a partnership model is one where we're buying a majority of the business. So the founder gets to keep the cash that we pay for the majority of the business, which is going to mitigate financial risk for them, help them hopefully set themselves up quite comfortably. But then they retain a minority equity stake. And our aim is to work together to grow the value of that minority equity stake such that the business, when we sell it a second time to a values aligned buyer, the original founder gets a second exit. And in working with us, we can do things, as I say, that they can't on their own. So the business can grow to a place that is beyond the imaginings of the typical founder of a group practice. And that value, and we can get into some of the numbers if it's interesting to you in the audience, but the value on that second exit, can be quite dramatic if we're all able to execute the partnership well. So this is why the most important answer to your question is that founder a good partner for us? Do they like us? Do we like them? Do we have differences in skills that we bring to the table? Are we complementary? It's a very high standard because I've said this on some other podcasts. When you're picking a business partner, the key question is, would you marry this person? It's a very high standard. So you have to feel a very high level of alignment for it to work. So that's by far the most important. There's lots of other things, of course, that we think about when deciding, is this a deal we want to do? But the most important thing is that partner alignment.
Yeah, I mean, you're echoing a lot of what I've read in books like Good to Great, right? It's like the first who are you going to work with? Then you move to the what, right? And what you're describing here is that the owner of the practice has done a good job of scaling this thing. They get a liquidity event, they take some risk off the table.
Yep.
And then the goal would be, right, from your perspective, that the second exit is bigger than the first one, right? Their minority exit on the enterprise is bigger than their majority exit on the first one, right? Is that the idea?
100%.
Yeah.
100%.
Yeah, so that places your value there. Going back to the numbers, can you break down the math on the value of a second liquidity event if and when you complete one of those?
I'll give you a very rough, I'm going to pull up my calculator as I do
Yeah.
this, but let's say, and we're going to keep the numbers relatively simple, but let's say, at the moment we're in May of 2025, and I've built an outpatient therapy practice to $1 million of EBITDA. That is roughly going to have a 5x multiple. In other words, the market is going to probably value that business at around, let's say, X the profit. Okay. So if there's $1 million of profit, we're going to say that business, very big picture, is going to be worth around $5 million. Let's say we work together, and after 4 or 5 years, we grow the business to $5 million of EBITDA, which is absolutely possible when you're adding new lines of service. If you're just doing therapy, it's going to be pretty hard to pull off an outcome like that. But if we get it to 5 million of EBITDA, it could be worth conservatively X in the market. So it could now be worth 40 million. That'll just give you a sense. So in the world of buying and selling businesses, just like buying and selling houses, the value goes up and down. But one of the big differences is that the value of a business can grow so much more typically than the value of real estate. And so even if the market is in a bit of a downstretch, that doesn't matter as much. What matters more is, hey, how much profit is this business producing? And the buyers in the world of buying and selling businesses value, right, the asset very differently than real estate buyers and sellers do. So if
That
you
makes
own a
sense.
chunk, if you own 30% of a business that's now worth 40 million, that's a pretty good second exit.
Yeah, that's very good. That's a very good second exit for sure. Yeah. What's your take on the rise of big therapy, if I can ask, right? These like large MSOs, these aggregators. What's your prediction? What are your thoughts?
So I kind of divide that world into a variety of different camps. And so when I was designing our model, with the help from a lot of people who have more expertise than I saw that there's a lot of benefits to scale, right? So there's the camp that just wants to buy as much as possible. One of the advantages of that is, hey, like we just said, you have a lot of leverage in dealing with insurers, right? And you can also potentially pay clinicians more, right? So that's nice. But a lot of the human touch is lost with that model. And we talk about like big MSOs. So what I like about them, in addition to what I just said, is that if there's non-clinicians involved who understand the value they bring, they can potentially be very good partners to clinician founders who typically don't have the business expertise that those of us who are non-clinicians bring. So that has the potential to be a good partnership. But most non-clinicians try to run the whole enchilada. That's one concern I have about big MSOs. They even get dangerously close to making healthcare decisions, which I would never make, have zero business making, right? And so you can sometimes get a little drunk on your own power. So you have to be very, very careful about that. And so that's why I say, we're looking to do 3 platform transactions. That's it, right? And
Wow.
so to me, I'm hoping that the best of both worlds. Big MSOs who are trying to go across the country, we could sort of put them in one camp. I think the incentives start to get a little dangerous when it starts to become entirely about certain expectations from certain investors to grow as quickly as possible. Then what we talked about in terms of sustainable growth, it may be harder to stay true to that, right? So that's a big reason why I say 3 platform transactions. So I think
makes a
that
lot of
the one
sense.
camp I'll say of like really big MSOs who are trying to go nationwide, they have the scale advantage, but there are those risks that I talked about.
Oh, for sure. And you couldn't do a platform transaction with clinicians in those MSOs, right? Or could you?
So we have looked at one. We have looked at one context where there already was an MSO, and they had certain non-clinical expertise that we had that could have been duplicative. And it was kind of interesting, but it's not the bread and butter. And so for various reasons, we passed. Incidentally, I think too much emphasis is placed in the world of acquisitions and roll-ups and MSOs. Too much emphasis is placed on the traditional idea that there needs to be synergies of like cost reductions and efficiencies and operational improvements. That matters and is absolutely part of our game plan. And there's something about just the right partners that matters more. So if you have the right humans in the right seats, that matters much more than I can save another 2% here, another 3% there. My strong belief is that if the right partners are there, you will figure out the problems as they come up, and it'll mean that there could be certain synergies that are off the table that you're not able to implement as much as someone that has $50 billion and is across the entire country, right? And decisions are going to get made from on high, and you've created another bureaucracy, which is
Right.
hard to relate to, right? And I'm just
Yeah.
not convinced that's best for the end patient.
Oh, well, you and I definitely agree about that. I think independent private practice, no matter the healthcare vertical, is where the best care happens. And anytime you get a clinician founder involved, there's just a different level of care that's implemented. And I think that's a very important factor, like what you just said. Are you the kind of person that thinks if you get the right clinician founder, the 2% cost savings is insignificant to the return you're going to get from that person sticking around long term?
1,000 times yes. A
Yeah.
1,000 times yes. Yeah. I'm
Yeah.
not going to lose sleep over the 2%.
No, no, you would lose sleep over losing the person at the top. Um, I have a couple more questions for you if you have the time. Um,
Please, please.
yeah. So my next question for you is that, your career has been fascinating. You've had a ton of diversity in what you've done. What's next for you in Fireside Strategic, and where can our listeners find out more about you and your work?
So the website is www.firesidestrategic, right? FIRESIDE strategic.com. Can also take a look at what we're doing on LinkedIn or the Your Group Practice podcast I run as well. I'm typically interviewing practice owners, although other interesting people like, Jeremy, for example. So the Your Group Practice podcast, which you can find on Apple, Spotify, all those good places, is a good one to follow. LinkedIn from time to time, as well as our website. And the focus for us is finding a few more of these platform transactions. That is almost all of what I do for work. And I have no idea what comes after that, but this is pretty good for now. I've never felt as aligned myself with any work that I've done. And, it's been a journey to get here. And I would encourage those people who know that they're supposed to do something awesome, haven't quite found it yet. You will find it. It may take you a little while, but it's worth it when you find it.
Oh, that's awesome. Yeah, that's great. My last question for you, Dan, for our time together is, the hope of this podcast is to give providers and their staff clear systems and best practices to win at revenue cycle management, to win at the game with the bureaucracies. And I love that you mentioned that, because we feel very similarly that we're playing a game within these systems, and there are ways to play it well, there are ways to lose at it. But if you had one word of insight around selecting the right insurance partner, or even selecting the right, perhaps, buyer partner, what would you say? What would you say to those people?
One of the things I look for when working with anyone, and maybe this is my neuroticism, I don't know, but how do they communicate? So you can watch in a world in which there are so many incentives to try to do 1,000 things. You're considering, working with a certain insurance company, you're considering working with a certain business partner. How do they communicate? Are they reliable? Most of the time, do they do what they say they're going to do? Or do they sort of disappear? And do you notice around something big like the exchange of money, do you notice that they seem to be behaving a little differently? Watching those signs is so, so important. And when it comes to playing the game that we're talking about with big insurers, it is a war of attrition so often. And so that means someone who follows up and communicates effectively. This shouldn't be that hard to find, and yet it is. It is so hard to find, right? And so that reliability, where reliability and communication meet, it's so simple, and yet it says so much about whether someone is truly going to be effective. And I've watched this journey for myself of a willingness to work with people that maybe weren't so organized. And at the time, I was less organized. I think often people were a reflection of the place where I was at. And as you develop more confidence in what you're doing, right, as your model of life or work starts to strengthen, as you gain confidence, I think you will attract people that are better communicators, that are more reliable. But watching in yourself and others, that reliability of communication, so important. And in the game of trying to persuade insurance companies to pay you more, you're going to be communicating so much. And if someone can't respond to the first email, it's not a good sign that they're going to be able to write 30 emails to an insurance company, 100.
That's true. Well, thank you, Dan, so much for being with us today. And we look forward to watching your work and watching what Fireside Strategic does. Yeah, thanks for being on.
Thank you for your very thoughtful questions, Jeremy. Had a blast.
If you enjoyed today's episode of The Claim Game, please take a moment to leave us a rating and review wherever you listen to your podcasts. It really helps new listeners to find us. Make sure you never miss an episode by subscribing to The Claim Game on your favorite podcast app. Your feedback means so much to us. We want to provide valuable education about revenue cycle management. So if there's something we didn't cover in our topic that was a burning question for you, please let us know so we can try to get you the information you desire. You can find the links to all resources we mentioned in this episode in the show notes. And if you want to dive deeper into our resources, we have 2 places you can do that. First, you can go to our blog at practicesol.com/blog, where we have 8 years of educational blogs. If you want to learn more about what Practice Solutions does, reach out. We'd love to hear from you. Just go to practicesol.com to learn more and to connect with one of our awesome people on our team. Thanks for listening. We are Jeremy and Catherine Zug, and this is The Claim Game. See you at the game table next time.